Before we get started, I just want to make a reminder to everybody that the information discussed today is not to be interpreted or construed as investment advice. Everyone's financial situation, goals, and objectives are different. Please consult investment advice.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble.
Welcome back to the Loonie Hour, episode 18. As always, we're joined by the three amigos. We got Rich Diaz, the Tom Brady of Macro, with a fresh haircut of Acorn Macro Consulting. And of course, everyone's favorite boomer, Mike Check, Keith Dicker with IceCap Asset Management. Welcome back to the show, gentlemen. We're going to try to steer clear of the political discussions after some feedback from last week's episode regarding the trucker convoy and whatnot, and our unacceptable views. But as I said to one loyal listener of the show, I said, if you try to please everyone, you will please nobody. So we will always speak our minds on the show. And I think, to be honest, I think that's why people actually listen to the show, because if it was plain Jane vanilla, you probably wouldn't tune in. So, but I said I wouldn't talk about it, but I'm going to talk about it for 2 minutes, and then I'm going to pivot. Because the only reason why is because we've got everyone really commenting now on this sort of trucker shutdowns, and more so from an economic macro perspective, which is what the show is all about. We had our fellow Bank of Canada governor, everyone's favorite Tiff Macklem, coming out a couple days ago, basically saying that should these sort of lockdowns and congestions happen, which are shutting down some of the supply chains. We've had Toyota, Ford recently coming out and saying that they're pausing manufacturing just because they can't get their supplies. That this could impact the path forward for the economy and slow growth and whatnot. So in my view is basically Tiff Macklem is almost looking for any kind of excuse. These central bankers in general looking for any kind of excuse not to raise interest rates. Keith, I don't know if you have any quick comments on that as you pour your coffee there, but I don't know if you have any quick comments from Tiff there.
Well, first of all, for the story starter, because I know everyone loves my stories. This is not even an old story, quick story. A few days ago, I was working as a knock on the door, and it was one of the career guys, and look what they dropped off at my desk.
Oh,
Did we show this yet? I know, it's a real nice Loonie Hour mug. If everyone in the podcast are listening, it's the Loonie Hour. It's our logo on it. It was sent to me from Steve, and I think Rich received one as well. But mine was actually filled with loonies. I don't think yours was, but mine was. So speaking of loonies, yeah, okay.
We'll be selling those on the website. $50 a mug, inflation.
It's okay. The prices are transitory.
No, but we will probably, once we get the website up for the Loonie Hour, realistically, we're hoping to get some swag out there, but we'll update you on that. Anyways, Keith, take it away.
Okay, but there's another quick story. It's about to do with money and a bag of money. Down in Bermuda a few years back, one of my good mates there, he was moving. So you have a moving house sale. You sell everything you own. And this guy is an Irishman, really funny guy. He had a bag of change, and he was like those Ziploc bags, and he had on the bag $50, I think. And this young guy comes in on his scooter, and he bought a fishing pole, and I see him over there holding the bag of money. And I said to Dave earlier, I said, "What do you sell a bag of money?" He said, "Yeah, it's a good laugh." He said, "I only think there's like $18." And I'm looking at him like, "Geez, this is at least $200 there money." He said, "No way." Anyway, so this young guy, he comes back home and says, "I'm going to buy a bag of money as well." So I think he paid $50 for the bag of money and the fishing pole. And we got a good laugh at it. And about an hour later, the kid comes back in and he says, "Yeah, do you have any more money for sale?"
The hell is going on in Bermuda?
I know, but I think this ties into to the Bank of Canada here. They're in the business of trying to sell. Well, they're in the business of trying to sell money and trying to sell stability and everything like that. And they got absolutely skewered there a couple of weeks ago when they didn't raise rates. And now all of a sudden, out of nowhere, he's now opening the door saying, maybe we're still going to raise rates, but we're going to have to wait a little bit before we do it, because of what's happening here with economics and on the the supply side that's happening in Canada. But we'll talk a lot more about that, because really though, it's central bank policy. It's being moved around by inflation, and I think the Americans had an inflation number this morning. Was that right?
Yeah, Rich,
Yep.
take it away for us in terms of the actual details, as the Tom Brady of macro is supposed to do. But basically, to preface everybody here, 7.5% year over year growth in the CPI inflation basket in the US. And Rich, I believe that was a 40-year high or something along those lines.
Yeah, 40-year high, more or less, 37, 38, whatever it is. But yeah, so what was expected? It was also more than expected. So that was interesting. So it was, and that's often when you're looking at these numbers, it's about expectations rather than the actual number. So it was expected to be 7.3. It was 7.5, as Keith said. So 0.6 month over month, which is quite the move. A couple of highlights from that. It was driven by food, energy, as you can imagine, with oil prices going up. Hopefully we'll touch on that later. And shelter, which is something I've been on the shelter train for a long time. Remember, shelter is a large part of the CPI basket in the US and in Canada. So it's about 41.6% of core and about 33% of the headline basket, and health and shelter went up to 4.4%. So, and that keeps rising, and I would expect it to keep rising. There's a couple, I'm happy to get into that as to why, but also food rose nearly 1% month on month. And again, we've said this before, and I'll just repeat myself again, which is these are the headline sort of aggregate figures. So when people say, how can you believe those, those numbers? It's probably much higher. I agree with you. It's probably much higher, which is scary for people on a fixed income. It's scary for people who aren't necessarily seeing their wages rise as much. And I think that there's more to come. There's more to come for two reasons. One, I think just the base effect still has to fully pass through. And so I think the comparables, the comps, as we say in the finance world, I think that we're sort of waiting until the March, April, May months for inflation to start to peter out. And then the other thing is, and the shelter component, which again is a lion's share of the CPI basket in the US and in Canada. I don't think that that's going down at all for two reasons. One, there's no supply. So rental vacancies are really tight, and then the house prices and rents in general are still quite high. Yes, mortgage rates are going up, and yes, mortgage applications and refinancing have fallen. However, that shelter component is something to really watch out for. I tweeted about it earlier this morning. But yeah, that's it for me. One thing on the Tiff Macklin thing, just in his defense, believe that, just to be fair, and I try to be as fair as possible, in Macklin's defense, the bridge that they're blocking, I can't remember the name of it, doesn't really matter, is a key supply line with the United States. Something probably Trudeau should have thought about. But be that as it may, it's something about 300 million. I could be wrong on this number, but I read it somewhere and I'll just take it at face value. It's about 300 million a day worth of trade goes along that bridge from the United States. So that's about 9 billion a month. And just to put into context, our trade with the US is about 45 billion a month. So it's about, 20 odd percent of all of Canada's trade is on that one bridge that's getting blocked. So he might have a little bit of a point. But anyway, Steve.
Yeah, no, just to kind of very well put, just to kind of summarize that. So basically, you were saying the shelter component makes up like roughly just over 30% of the basket of consumer price inflation. Yeah, I find it kind of interesting that, again, shelter, at least in the US, are saying it's just over 4%. underreported in my estimate, based on my view of watching U.S. home prices, and I know rent growth has been following suit. And then you were talking on, so you got the consumer price inflation basket there. That hurdle rate, because you've got CPI at 7.5, and I think everyone could make an argument again when you've got shelter at 4, which is arguably much higher. Like what's like the hurdle rate? Because we're talking about like fixed income, right? And I just I keep thinking about like my dad, who, God bless his soul, watches this show, regular listener. But he just recently retired, and like he's telling me, I've just went to the bank, got one of the advisors there is talking about, liquidating one of his GICs. And this guy's got I think he was saying his GIC was getting 0.25%. And it's and this is someone that's retired. And so, okay, inflation in Canada is arguably, I think the most recent print is 5%. I would argue it's probably closer to the US, which is 7.5, which again is, let's call it a hurdle rate of 10%, basically. That's a tax. This guy's basically just got taxed roughly 9.5% on his money. And if you start compounding, obviously inflation is probably not going to continue at this rate, but you start compounding that over 5-10 years.
So let me quickly just say that. So number one, so what you're saying, there's real interest rates are negative. So what does that mean? It's just that inflation is higher than the bond yield. Okay. Meaning you need to run. So you're running fast and you're falling behind, right? But the other thing that's really, so that's what you're trying to outline. We've made it very clear on this show that we hate bonds. I stand by that view. What's another thing that's really interesting is as the bond, so that's if you're just holding the bonds relative to inflation. The other thing is what I've seen, and something I want to point out to the listeners today, is that the bond index in general is starting to fall. So the global bond index is what I look at. You guys can look it up online. It's called the IBOXX. US dollar terms, doesn't really matter. They're all sort of the same, but it tries to aggregate the entire sort of global bond market. It's got a duration of about 7 years. These are all sort of technical things, but the point is that index, which is what I track and what I talk about with my clients, is down 7% from the peak. And so, which includes your yield. So the coupon that you clip every year or semi-annually or quarterly or whatever. And that's in nominal terms. So you can imagine how much money, if you're holding a bond index, how much money you've lost, number one, in nominal terms, over the last, let's say 2 years. And then in real terms, you've lost even more money because obviously inflation's ripping and, this is basically falling. And so it's just really incredible. These we've talked about this before, and I'm sure we'll talk about it again. These bonds are, in my view, they're worthless. And it's really a shame.
So let's get the money manager in here. Keith, what do you do? What do you do in this situation? How do you view this? How do you have this conversation with clients? As I know, Rich hates bonds. I don't like bonds. I'm a millennial. I don't even know what the hell those are. Keith, take it away.
Well, first of all, Rich and Steve and everyone else out there, all you young guys out there, it's called the Ambassador Bridge. Guys, you should know that. And you are correct. It is the busiest, most important economic related bridge in Canada. So remember that, the Ambassador Bridge.
Do they play hockey on the bridge?
A lot of hockey flows back and forth on that bridge. Absolutely. So guys, this is, sort of turning in. So what I love about markets is that almost everyone, they start with the stock market and then they end with the stock market. That's where they go. But the world is driven by credit, and credit is really people borrowing money. And when you borrow money, you're issuing a bond. So countries borrow money, provinces, states, cities, companies, households, everyone's borrowing money all the time. And what's happening now is that the growth rate in borrowing and debt, it is faster than the GDP growth. It is now actually, because rates have been so low for so long, it's actually growing twice as fast as GDP. So GDP has to, so to get the debt bubble under control without it popping, the global economy has to start growing really super duper fast. That has to happen. And at the same time, it has to grow in a way that interest rates do not go up. And you can't do that. It just doesn't reconcile. So again, this is I saw an article in The Economist, I think it was this morning. Last year, so there's $300 trillion in debt outstanding around the world. So 300 trillion, isn't enormous. Last year, $10 trillion was paid out in interest. The Economist is expecting that if interest rates increase by 1% over 3 years, that's it. So we've already gone up 1% in what, Rich, 3 months maybe on the 10-year?
Basically, yeah.
So like a gradual trickle higher of 1% over 3 years. The amount of interest to be paid is going to increase to $16 trillion. So we work this out as a percentage of GDP, or for everyone who's listening to the show, a percentage of your income that's coming into your house. So everyone's working, money's coming in. You know, if you're a realtor in Kitsilano, you got a lot of income coming in. But you know, most households, they have a steady income. So let's just say, for example, right now, 12% of your income is being used to pay on your interest on your mortgage and credit cards, whatever else you have. That's going to shoot up very quickly to 15, 17, 20%, depending on how high interest rates go. So think about it again. So that's just from people that are borrowing and paying off the money. From an investment perspective, in the conversation that we have with everyone, which leads into the question that you were just asking about the bond market, it's a lot of risk in the bond market. So I always tell people, and I have the same conversation with all clients and investors from, you know, across Canada, down the US, Europe, you name it. Right now, the bond market, it is what we call an asymmetrical risk return opportunity. Your upside is, say, 2%, and your downside is, you know, -5, -10, -15%. And then if you get into like the really smart world, like the way Rich was talking there, if you put what is the real return on it, because inflation is higher as well, and then it's your after tax, like this is a one-way highway investing in the bond market right now, and you're going in the wrong direction if you're jumping into that market.
Off the bridge, one might say.
Yeah, there you go. The bridge. I like that. Hey, you brought that in. Now, that's not to say bonds don't add any value, because they can certainly help you, you know, cushion some blows. And you know, for any institutional people out there, in the consultants, you know, you're buying long-term bonds, not for the return. You're buying it to offset your liability side and on the pension payments and whatever. But Steve, it's not looking very good in that world. So what you want to do as an investment manager is find other investments that can also produce income, but that are going to be to a different drum than, say, the stock market or the bond market and everything. But we'll get more into the bond market as well. But one key thing that Rich was talking about, that he didn't use this word, but I will. It's credit spreads. The credit spreads have the potential here to really blow out, and then that's the. So I think that the bond market index that you mentioned, I don't think there's a lot of credit in it. I think it's mostly sovereign debt. Yeah. So most of the bond funds that Canadians are investing in, there's corporate debt in there, and then the average Canadian, if you're walking into your bank or, you know, mutual fund sales guy you're dealing with, your bond fund, it probably also holds high yield bonds or junk bonds, and that stuff is completely exposed to credit spreads blowing out wider. And, you know, that's the stuff that we get excited about right now, because it's creating opportunities elsewhere.
Yeah, I mean, I think let's just call it what it is. I mean, it's a global sovereign debt bubble. Like, that's just it's what it is. Like, it's, you know, you run those numbers. I'm glad you brought that up, because I was actually going to talk about it as well. Yeah, I mean, yeah, going from global interest payments rising from 10 trillion to 16 trillion just by 100 basis point move. I mean, it kind of tells you're basically in, like, I mean, it's almost it's a failing system. It's almost like a Ponzi scheme. I mean, that's why, like, it's always funny, because I always get these. Even last week, did a couple interviews on the housing market for just mainstream media outlets, right? And they're always question is like, well, like, I don't get it. Like, house prices are rising. Like, what's causing it? Where's the money coming from? I'm like, the only thing that matters is like global bond market. Like that's, I mean, if you've got, I mean, that's basically your risk-free rate, right? I mean, if that, so long as you have real negative interest rates of, 5, 6, 7, 8%, I mean, you're just going to continue to get egregious amounts of capital flowing into real estate because it's just looking for a place to park itself. And so, again, and then you get the average person that doesn't know what the hell is going on. And they just start saying, I got to point the finger at somebody. So I'm going to point it at, it must be that guy it must be that real estate investor. He's the problem. And it's like, no, the problem is that you've got a global sovereign debt bubble that, we're trying to keep this thing together with a bunch of duct tape. And I don't think it's fixable. I don't think it's solvable. And I think we've talked about it on the show before. Speaking of which, alternative assets, as Keith was talking about, we had KPMG Canada, one of our largest accounting firms there, just recently added Bitcoin and Ethereum onto their balance sheet. So, I mean, what a time to be alive. Keith is very upset, shaking his head right now. Yeah, I mean, I don't know if you have any thoughts on that, Rich, but I'm super pumped. Obviously, you guys know I've got the laser eyes there on Twitter. So yeah, I think it's a pretty big move to see a massive accounting firm add that to their balance sheet. Keith joked if it was on the asset or the liability side, but that's neither here nor there.
Yeah, I mean, I think it's really, I love those kinds of things are like, I like schisms and breaks and inflection points, and I think we're sort of reaching one. I mean, who knows? If I was a central banker, I'd be doing everything in my power to not let those kinds of things happen. I think it shows you how sort of behind the curve they are with respect to that. Part of being a government is that you have a monopoly on money creation, right? You have it in several ways. You can tax people, you can run inflation really high. You can ban certain transactions. You can ostensibly try to investigate money laundering, although our government seems to not care about that. But the point is you have a captive audience, you have citizens, and I think the to me what's really fascinating and which should feel like an existential threat for these central governments is that for the first time, probably, I don't know, ever, you have this like genuinely alternative asset, like outside of the normal way of doing business. And, who knows who will be the winner, whether it be Bitcoin or Dogecoin or Mousecoin or Apple coin or whatever. But like, the point is the idea that I can't speak to who's going to win, who's going to lose. I just think from stepping back as like a lover of economic history and financial market lore and all these things, I think it's really cool. I think it's like a great time to be alive. I know it's not I don't have much more to contribute than that. Keith?
No,
or Steve?
Yeah, I mean, I was just going to say, because I think there's a lot of people that like aren't necessarily familiar with the space. And like, I'm not the expert in the space, but I do a lot of research, obviously, I'm a millennial, so I have to kind of like this stuff. But I think people have to understand, like, it's not just like a lot of these, yes, there's like Dogecoin is just a coin for speculating. Essentially, there's not really any utility value, but like you do have a lot of programs, like for example, like Ethereum, like these central bank digital currencies, for example, are basically being built on that platform. So like, just so people understand, like these, like a lot of these tokens have zero utility, and there's a lot of them that are actually going to be functioning in your real life scenario. I think Ethereum's settlement layer, I think they settled like $6 trillion worth of transactions last year. And like I said, central bank digital currencies will be built on some of this tech. So yeah, I mean, it's going to be interesting to see sort of how that plays out. Keith, I don't know if you have any comments on that, but
how do you spell it? It's okay. So guys, just from a market perspective, that space did incredibly well in a very short time frame. And the only reason that happened because all this capital was gushing into it. So supply was nowhere near enough to keep up the demand. So the price of any market is going to go up. And now a lot of that's been coming out. Now it's, it's sort of treading water here, depending on, which, most people are using Bitcoin, of course, as, the benchmark for the whole crypto world. So I do know a lot more about it than, we like to joke about. But we've talked about central bank digital currencies before, and how that's going to come together. But with KPMG announcing, hey, we have some of this in our balance sheet right now. It's again, the more that the established world adopts crypto, they're investing in it, allocating towards it. That just means it is here to stay. It's not going to get eliminated or wiped out. I'd be shocked if the Federal Reserve was afraid of Bitcoin. I really don't. They're not afraid of gold. They're not afraid of crypto.
You can't buy chocolate bars with gold.
And I still don't think anyone's going to be buying. Like, people keep
you
saying
went in to buy it.
Go ahead.
Yeah, but if you go in to sort of try to buy something, one of my friends, he joked, he tried to buy something, this is Bitcoin wallet there a while back, and he said like the spread on doing that purchase, it was like something 5 times what it would have cost him to do it otherwise. So anyway, we're not there yet, but from a pure investment perspective, with increasingly more players allocating capital towards it, that's incredibly positive. Whether I'll be right or wrong, I do sort of envision the space as being similar to the whole tech bubble in like 99, 2000. All the capital went in like hand over fist first. Like I remember again, because I was around back then. But like if you just announced you had a website all of a sudden, like Canadian Tire, like the most iconic Canadian brand out there, and their stores, it's a shit show. Like it's so disorganized, and every single retail out you go in, and all of a sudden they announce. I know, but yeah, it's a great place, all right. But we all spend time there. But obviously, like if they announce we now have a website, like the stock doubles in value. And of course, it took a few years later for the true value of all this innovation that was taking place. Now, I assume that's what will happen in this space as well. So it's not something to be ignored. But it's certainly not a market that I would be aggressively going into in any way. Rich, would you have your hand up?
Sorry, I just want to say
the young student in the back of the class has a question. Yes, sir.
One thing I forgot to mention, which I thought was really, really bullish for Bitcoin, was that paradoxically, the fact that the U.S. wants to regulate it, which is, I think, to me, what I've been waiting for a long time. I think that gives it, in the same way that KPMG putting crypto on its balance sheet, gives it an air of legitimacy that it may or may not have had before. I think if the U.S. starts to regulate that market and sort of get some, I don't know whether it's the SEC or whoever is going to do it, but as you start to build in like the statutes and the law books, and it starts to be, I think it becomes like a much more attractive and viable place to hold, I don't know, your wealth, a unit of account. And I think it's just a really fascinating, that was just recently actually when they did that. Sorry, Steve.
Yeah. With the regulators, just to add, like we are a regulated entity. We're licensed in Canada for stuff as well as down the US to do stuff. So the whole thing about it being regulated in the US, you have to understand, in the US, there are multiple regulators, and it's a big power grab for each one. So there was a lot of discussions taking place behind the scenes because they, the SEC would want it, the CFTC/NFA would want it, and so forth. So, being regulated is good. But it's also, don't underestimate governments and the way they're set up and structured. Everyone is always looking to increase their market share. And so as soon as all of a sudden a new, investment pops up on this scene, you all of a sudden you're a regulator, you wake up and say, wait, I need that. Because all of a sudden then your budget increases, your power increases and whatnot. But again, guys, like this will be around for a while. And it's not going to, anyone who's thinking, they're going to, double their money every month for 18 months and then they'll never have to work and everything. I think that might be a bit optimistic on the way it might play out.
Thanks a lot. We just lost a whole bunch of listeners now. No, I think you're right there. I think that, as someone that is a astute observer of the space, I think that there's a lot of this stuff that as Keith mentioned, a lot of it is going to be sort of .com. A lot of these tokens will go, to zero. And I think you're going to have a lot of the blue chips that will continue on and do exponentially well. It's funny enough, actually, of course, it comes out of Vancouver, which is the sort of mortgage lending hot space. But there's actually a company in Vancouver that originated the first ever mortgage in the metaverse. So there's now mortgages being issued in the metaverse. So I think that is also going to be a space to watch, but I think it's extremely early. There's going to be a lot of it's kind of like the modern gold rush, right? Like you're almost better off selling the picks and shovels and whatnot. But
I have one more comment. I think it's important. And again, it's just to share with everyone how the world works here. So the older guys around the world, like myself, we're the ones that have a big influence on where capital is going to go. And then all the younger kids out there, you guys are coming with the great ideas and stuff like that. For this metaverse stuff, the mortgage product in the metaverse world, alternative universe, whatever you want to call it. For that stuff to really kick in, you need the older people who are in charge of capital for them to say, yeah, you know what, we're going to start allocating money to that space. And so that's what I mean, that by the time older money starts going to the space, that first initial ramp, that opportunity might be gone. But people who are fiduciaries to other people's wealth and savings, we don't aggressively go into new ideas on the ground up. That's something that it's very aggressive investing, and some places do and everything, but the majority of investment money around the world, we're pretty conservative, and we like to wait for things to play out, and that's just the way things would work. So anyone, if you're younger and you're investing in this space, just have patience with it. Like let it play out, and don't get too disappointed or too excited, because it will take a time. But when it does start to work, when you see big money like KPMG saying they're going into it and stuff like that, that's when you realize, okay, yeah, like now this is starting to reach that not maturity scale, but you're getting into that space where people are taking it more seriously. So that's my last thought for it.
I mean, I think that's a perfect way to actually summarize. Because I think it's important to contextualize people. Like, your wealth manager's job is to preserve your capital. Like, it's to preserve your wealth. It's not necessarily it's not to make you rich, right? So if you're going to take speculative bets on, in the crypto space, you can't really ask or expect your wealth manager to do that. It's not really their job. Their job is to preserve and protect your capital that you've worked hard for over the last 10, 20 years, either through working or building a business. So that's an important takeaway. I actually just wanted to comment quickly on kind of our whole discussion here. If you don't mind, I'm just going to read this out. Keith, our boy Ritesh, also posted this one, kind of following up to the conversation about interest payments rising on a 100 basis point increase. So this is from Hirschman Capital, very well respected firm, Hirschman Capital. They say the Fed can halt inflation by hiking interest rates as it did to end the 1970s inflation, which everybody on Twitter seems to have an opinion on. Oh, this is the 1980s again. Watch Paul Volcker come out and start hiking rates to quell inflation, blah, 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 blah. So it goes from 1979 to 81. The Fed hiked the Fed funds rate by 100 basis points to curtail inflation. In 1979, however, U.S. government's debt to GDP ratio was only 31% of GDP, and its budget deficit was only 2% of GDP. Thus, the hike's impact on the U.S. government's interest burden was manageable. By 1983, the budget deficit had increased only 4 percentage points to 6% of GDP. Today, a 300 basis point Fed funds hike, a fraction of the Fed's 1979 to 81 hike, anyways, it was 1,000 basis points they had increased back in the day. So they're saying today, if the Fed was just to raise rates by 300 basis points, a fraction of the Fed's 1979 to 81 hike is easily foreseeable. some would argue. I would disagree, but this would still leave the real Fed funds rate lower than it has been for 98% of the last 67 years. Even some members of the perpetually optimistic FOMC are projecting a 300 basis point Fed funds rate by 2024. Today, however, the US government's debt to GDP ratio is 120%, and its budget deficit is forecast to be 7% of GDP this year. In other words, a 300 basis point hike should increase the budget deficit to 11% of GDP. Since 1991, all 18 other governments with deficits exceeding 11% of GDP and debt to GDP ratios exceeding 110% defaulted within 2 years. So let me just repeat that. A 300 basis point hike should increase the budget deficit to 11% of GDP. Since 1991, all 18 other governments with deficits exceeding 11% of GDP and debt to GDP ratios exceeding 110% defaulted within 2 years. Thus, the Fed could soon be trapped. Raising rates could trigger default, and not raising them could leave inflation unchecked. That's Hirschman Capital.
So that was great. I got to step in and take this. They're not going to do that. Inflation is the policy. Like, this is what I think we all need to wrap our heads around. And one thing that Keith mentioned earlier, he's like, oh, that basically interest payments will grow relative to the size of your balance sheet, relative to the size of your inflows. There's another way that you can pay down debt, which is to not pay it down at all, or to inflate your way out of it. And I think that your nominal debt, a lot of these figures are 110% of debt to nominal GDP. Your deficit spending is deficit spending relative to nominal GDP. And if you allow, so right now I've garbled this before, but the implicit price deflator is 7%. And what is that? The IPD is the inflation for the whole economy. And if you have a run rate of 6, 5, 6, 7%, or even 4% for 3 or 4 years, those nominal debt to GDP numbers can come down really, really quickly, as they did in the 1940s. I understand the growth was better. But the point is, the idea that the US is going to default in a real way and hand over the reins of the global dollar reserve to either Russia or China or whatever it is, when really the more obvious, easier, less painful way is to just allow your nominal GDP growth to run hot. I really don't understand the obsession, sorry to say, with the idea that the US is going to default. It's not going to. Bondholders will just be holding an empty sack of worthless coins. And I think and so how do you protect yourself? I think the market's telling you right now. And I'm sure Keith has loads of really interesting ways to do that too. But I think there are different ways to default in debt. And I think that to me, this kind of brutally obvious one to me is just to inflate your way out of it. I don't know if you guys have any pushback on that.
Yeah, no. Well, a pushback on half of it and a pull in the other half. I'm really witty today, by the way. So first of all, sovereign debt, they default differently than companies and households, right? So a country will default on the debt by taking that 2-year bond and extending it to a 200-year bond, or say it's supposed to pay out 5% a year. All of a sudden they say, you know what, we're going to only pay you 1% a year. So that, they just change the terms of it, which is still, it's technically a default, but it's different than if a household or a company defaults, because when that happens, there's a permanent loss. It gets marked on your portfolio. So I think that's where we're likely going to go. You're going to see sovereign debt defaults, but instead, like for example, it'll be Italy changing their 10-year bond to a 100-year maturity.
Like Greece did a couple of years ago.
Yeah, stuff like that. And plus, they'll say, by the way, there's no secondary market, so you're stuck with it. That's where I suspect we're going to go. The whole thing about it's economic fairy tales that we're going to inflate our way out of our debt problem, because again we talked about this before, and that the only way that happens is if you if you stop running deficits and you stop borrowing more than what you're collecting in. So you still have to pay down your debt or not borrow as much. But clearly, as we just said, the whole world continues to borrow way more. The growth of debt is faster than we're able to grow with income. So in trying to inflate the way out of it, that's not going to work either. Okay. So I just want to return. Sorry, Steve, for you.
Well, I got
confused.
a question for you. Well, yeah, because you're talking about, and I certainly I share the same view as you that, you'll see some of these countries issue, 100-year debt. I mean, is it, in your opinion, do you foresee a lot of countries, Canada obviously being the number one here, doing this on the mortgage side as well, like in order to sustain this housing Ponzi that we've created? Let's say the housing market here wobbles 10%, 20%. Do you foresee like 40-year mortgages coming back, 50-year mortgages? Because you have to, it is what it is. Like, it's a credit-based financial system, especially the housing market. You need to continue to basically add more credit into the system, keep prices sustained. Do you foresee that as well? Like over the next, not talking right away, but like over the next 5 to 10 years from now?
No, not at all. And not in Canada, because the bank needs a comparable product to lay that risk off with. So the reason in Canada you see mostly 5-year term mortgages, for example, is because the Canadians sovereign debt market is just the 5-year, 10-year. That's it. So for mortgage for banks to issue, say, a 30, 40, 50-year term mortgage,
amortization. Sorry, is what I meant.
Oh, amortization is different. Yeah, I mean they can absolutely do that, but that part doesn't matter to the banks. Because really they're worried about, okay, how do we lay off? We have a 5-year term, built into it. So say there's, 8 different terms to run.
Yeah, I meant on the amortization side, just to kind of to try to keep. I mean, I just don't see how it's sustainable otherwise. I think we're already, at least in Vancouver.
I can see it happening. However, I don't think we'll get to that stage. Like, I really think the probability of the world experiencing a severe debt crisis, it's gone from 10% up to 50%, 50%, half 100 or more. Like we're on really thin ice here right now. I still don't think it's Canada will be the epicenter behind this. Canada will experience the wake because it will happen somewhere else. And I'm very consistent with my view on that, because I think that's where we continue to go. But it will. So if the only way we can go to these like 40-year amortization periods, all that stuff, is if the world just slowly adapts to higher gradual interest rates. And like with the way the bond market is trading today, like I'm watching it here, like this is an epic day in the bond world. So let's just shift the attention a little bit here, if it's okay, because I just want to revisit a conversation we had a few weeks back. And again, so we like to stay consistent and see if things are playing out. Because I remember a few weeks back, we talked about on one of our calls then that it's likely that Powell is now set up to be the fall guy. We need a major disruption in financial markets, and then he'll leave, and Brainerd will then come in as the head of the Fed, and they'll continue on with more QE and lowering rates and everything like that. So right now, for example, the market is expecting the Fed funds rate to get up to almost 2%. I mean, that's where they're going. 1.25% is baked into the cake. They're even suggesting we could get a 50 basis points or 0.5% increase come at the next meeting on March 16th. That's coming up. And so I like to look at the investment world as, people don't believe this, but you want to buy low and sell high. Most people do the opposite. That's and it doesn't work out that well. But you have to look at extremes in markets where it's trading. So we mentioned earlier, how do you position portfolios? For example, in our portfolio, we had a holding there that's benefiting from the bond market selling off. So like we're making money here today on that. Like that's been a great addition to our portfolio. But we're also getting to points where these trends, they're now on their last legs. So using the baseball innings analogy, I think the right story might be in the 8th inning, 7th inning, something like that. So right now, the 10-year in the US is trading, it just went over 2% this morning, which is crazy because we were at 0.7% there in the middle of 2020, I think it was, wasn't it, Rich?
Your US mortgage rates are basically back at pre-pandemic levels.
Yeah, it's pretty aggressive here. But so the story that I told there a few weeks back was, you know what, the Fed will try to start raising rates, stop QE, start doing QT. You know, they're buying the bonds, we're selling the bonds actually onto the market, and but to get to that point, you know, it's been suggested to me, and I know some pretty sharp guys that are very close to the Fed and whatnot. And one of them just shared a conversation with me yesterday saying, hey, like this is moving along as they expected, you know, they believe, you know, it'll be like a Fed/Treasury induced correction in the market. And it's playing out exactly as they thought at the long end of the curve. So like the 10-year bond is selling off. They see that happening. They also expect equities to come off hard, and they haven't. Equities have not come off really hard. I mean, they could come down 10% easily.
Some of them
quickly.
Some of them have.
Yeah, but that's like the, you know, I call it the ARK funds. Like some of those.
Well, no, I mean, Facebook's down 20%. I mean,
yeah, but I put that in that. I mean, like S&P 500. You know, like add in your Procter and Gamble's. And remember, I'm an old guy, right? I like buying companies that sell stuff.
I mean, there's something I want to touch on later there, but carry on.
Yeah. So again, like this narrative continues to play out, and like the next sort of straw that can break the back here in the investment market, it's if the high yield market snaps, because when the bond market is selling off right now, you know, pension funds and mutual funds, like they're just losses on paper. Like there's no one getting hurt really, because they're hoping it will bounce back. But as soon as the high yield market snaps, money runs away from that very, very quickly, and then losses do occur. And remember what the Fed did for the first time in the history? It was very anti-Fed because they're not allowed to do it, but they did it anyway. They bailed out corporate debt back in March of 2020. So again, right now the market has said, hey, the Fed is going to raise rates aggressively. So we said, hey, the Bank of Canada do the same thing, the Brits and everyone else. We're rapidly approaching the point where markets now will start anticipating. I actually saw it this morning in an article. The markets are now anticipating a rate cut. So they're anticipating rate hikes and then cuts down the road. So one of the best trades coming up right now, remember I mentioned the Canadian Bankers Acceptance Contract there a couple of weeks ago?
Yep.
Yeah. So the biggest market in the world to play interest rate direction is the Euro-dollar contract in the US. And so that now is looking really nice. It's one of these.
Do you want to explain that to the listener that maybe isn't quite familiar with the Euro-dollar market, and give it in very plain English?
Yeah, and again, this is not an investment advice. We don't do that on the Loonie Hour.
We don't know what we're talking about.
Yeah, and this this is not a trade you can walk into RBC and do. This is what, you know, big money is doing if you have access to it. But basically, the instrument that tracks the Federal Reserve overnight interest rate is called the Euro-dollar contract. It has nothing to do with euros or Europe. It's just the name they have attached to it because it operates outside the banking system, so to speak. But right now, that's priced at $98 now this morning. So it's effectively saying 3 months from now, the U.S. Federal Reserve funds rate will be at 2%. And that's what it's saying this morning. So if you take the view that, hey, we could get a sharp correction in the stock market coming up any minute now, and the high yield bond market can trade off any minute now, all of a sudden the Federal Reserve and Powell exits. He says, you know, smell you later, and the new person comes in. All of a sudden now they have ammunition to do what, you know, you suggested Tiff Macklem is doing now, coming up saying, you know what, we don't need to hike rates anymore. Then all of a sudden the price of that Euro-dollar contract, it just slingshots higher. So it's like, you guys don't know Evel Knievel, do you? That's too.
Yeah, I know.
They used to shoot him out of the cannon, or maybe Super Dave Osborne. Let's stick with the Canadian stuff. They used to shoot Super Dave out of stuff. That's how it would be like.
So can I take the
shot higher?
I would definitely have a different view of how this is all going to play it out. I have a much more constructive view on growth. I also have a pretty clear understanding of what's going to happen in the inflation world. And so given that inflation, yes, everybody's talking about it now, but there's two things that are really important. Number one is the worries about inflation sort of, I think you should always discount the peak political froth. And if you look at, and we'll share this chart, if you look at inflation, yes, it's a function of shelter. I've made that clear, but it's also a function of commodity prices. And commodity prices have rolled over about their year-on-year change is what matters and which drives the change in inflation. And those year-on-year price changes peaked about 3 or 4 months ago. What's going to happen the inflation rate has dutifully followed that delta. So the inflation follows the change in commodity prices. You're going to get that rollover for a couple of reasons. One, I mentioned the base effect in inflation. It's very, very hard to sustain those ever increasing rates of inflation. So you have the base effect coming in. You have the commodity price basically has slowed coming in. And so you can get inflation rollover before the end of the summer. That's going to change everyone's math on the rate hikes. And I think that those rate hikes, as in the past, I think it's important to remind everybody, those rate hikes are not locked in stone, as January 26th in Canada will tell you that. Those are bets. People are making bets, and they're making bets on what they think is going to happen. What they think can happen will change as the data comes through. And I think it would not be surprised me at all that those rate expectations will start to come off when inflation starts to come off. So let's also remember that we're still in the pandemic. In some people's minds, they want to be in the pandemic forever. Let's ignore those. In other people's minds, the pandemic is coming to an end. And what does that mean? It means a lot of the supply stuff that we've been worried about is going to end quite naturally. People are going to get back to work. The ISM came out again, it fell. And again, the major issue that producers are having with respect to growth, sales, and production is they aren't getting enough people in bums and seats to make their manufacturing and services companies tick properly, which is putting strains on their supply, which is keeping prices higher. We had one of the largest increases in the labor market or non-farm payrolls last week or this week, whatever. People are going to get back to work, which is going to ease supply chain, which is going to further put ease on those transitory inflation things, which in my view will again take the pressure off the Federal Reserve to raise rates by this extreme amount. And if you have that, you say, well, Richard, can the labor market withstand higher inflation? Because I don't think it's transitory, but inflation won't be at 7, it'll be at 4. And then the issue is, can the labor market withstand inflation that's high, but not extreme? And I would argue, yes. Wages and wage growth are going higher because of demographic things. You have, and I think the US, and especially in the US, has an extremely strong household balance sheet. Debt to GDP is 30% lower than it was at the peak. And finally, the banks, which is where the error term, where it's, where the rubber meets the road, are extremely, extremely solvent. You could say they're over collateralized. And we know that credit growth is growing in the household sector and the commercial and industrial loan sector. So this idea that the Fed is just going to raise rates with impunity without looking at the data as it comes out, I don't buy that. And I think that you're in a situation, weirdly, that you could actually have a Goldilocks scenario where you have inflation going low, real rates stay relatively negative, households are okay, and there isn't end growth. Not to mention, just to put the cherry on top, that the second largest economy in the world, China, is massively, massively easing and is going to start helping with the unlocking of those supply chains. Because as soon as the Olympics are over, they're going to end this stupid zero COVID policy. So there's the other side of that. And, if you have that, you have margins stay okay, earnings growth be okay, and a situation where what you really do is you have the rotation out of the shit, which is what we're seeing now in the equity market with the QQQ down 10% year to date, and into things that make money and have strong margins, which is energy, banks, materials, consumer staples, et cetera, et cetera. So, who says we don't argue on this channel? Because I think that's a pretty cogent counter view to Keith's very eloquently put stance.
I think I've been moderating this because I know you guys have different views on how this plays out. But correct me if I'm wrong, just to kind of wrap up the show here. I think we were talking about this off air. I think you guys are still kind of coming to the same conclusion of like where, for example, the stock market is at the end of the year. I think you guys just have different views on the pathway there, which is Keith is kind of the view that you're going to have some in the near term, you're going to have some volatility and a drawdown before we have easing. And I think Rich, your basically prognosis is that it might be a little bit choppy, but for the most part, it's still a bullish setup for equities. I mean,
Yeah, well,
you
for me,
guys,
it's just the
you guys are
rotation.
still,
I mean,
you guys are
the
still
rotation. I think we don't talk about. Sorry, go ahead.
It's just the rotation of. But I mean, if we're just looking at strictly the S&P 500 index, for example, I believe that you guys are more so basically in the same camp that it finishes 2022 at its long-term historical return, which is what, 10% a year?
Yeah, we bet on this.
Someone remind the listeners here, what's the next bet here for the Twinkie bet?
Well, let's just so first of all, the reason Rich is wrong most of the time with things, and I'm right. So, but the difference between Rich's view on markets in the world and in the view that I share with people, I'm coming at a view from financial market perspective, and Rich is coming from an economic perspective, and both can be right. So, however, again, this is IceCap, and we have a very strong view of this, and it will never change. There's always moments of time in the world where financial markets, they do not move in line with the real economy. So you can have economic data going in one direction, and financial markets are going in the opposite direction. And you can have the opposite of that of taking place as well. So, what Rich just shared with us, his view, all that is economic. So I'm hearing it. I'm just hearing, hey, economics this, economics that. The view that I'm sharing is that, financial markets, they're set up, they can come off pretty hard here. And then that gives policymakers cover not to raise rates. That's what it is. So, and I know it can be confusing for a lot of people if they're not in the world, but again, there's like, we used to like to play this game all the time. We'd say, hey, if you knew a year ago that inflation was going to be at 7%, where do you think this market would be and that market would be, and so forth. And they rarely reconcile. So again, there's always a big difference between the two, and that's what I share. And that's why Rich will be wrong with this in the near term.
I'm just saying, energy, banks and energy. I'm just saying.
Someone's going to be stuffing down some Twinkies here on the show.
But again, though, I think one of the best, I just said, this Eurodollar market is really catching up here. And, but I think another one of the great trades that are coming up here, I think I just saw the BBC news reporter in the background. You guys remember that there a few years ago? Anyway, but one of the greatest trades I was involved was when oil spiked up to 146, 147. I think it was back in 05 or 6 or something. I want to see oil. I wanted to see go vertical because, boy, the opportunity then to short that thing, it's there. It's a lot better.
We talk about oil.
Yeah, I think though for time we'll go in the next episode.
Okay, fine.
That, maybe.
All right, we got it. Okay.
Yeah. Cool.
I want to hear Rich's thoughts on the oil market for next week's show. Because I just added another property there in Alberta, so I'm probably more in Rich's view camp here. But we're getting to that in the next show. We just had a master class on economics and financial markets. So as always, we appreciate the support. I actually didn't give the usual plug, which is all we ask is that you share this episode with one friend, one person, share this episode, take the audio link from Spotify or Apple Podcasts or Google, share it with one person. Let's continue to grow the Loonie Hour community. We appreciate your support. And as always, we will see you next week.